Welcome back, dividend investors. Today we're going to take a closer look at Procter Gamble, stock ticker PG, and you probably all know them very well. They have a plethora of different brands under them. Currently they are trading at $153, and year to date they are up 1.3%. Zooming out a little bit, they are up around 5% over the last year, but it is also a pretty defensive stock, so I'm not surprised that in these times that the stock price has risen to the levels they have. Investors were clearly happy with the last earnings result, which gave an uptick in the share price. They saw a particular rise in sales and EPS during last quarter. Outlook is looking really positive, and with a come-off in inflation, EPS growth could also be higher than forecasted in the future. Looking at some of the dividend stats, you can see here the dividend yield is 2.45 going forward, with a payout ratio just above 60%. It's pretty slow, growing around 5% over the last 5 years, but look at this dividend growth for 66 consecutive years. Looking at the dividend history, you can see here, started all the way back, and then it's how we would like to see it, up and to the right. Jumping a bit into the financials, you can see in the income statement that revenue is indeed growing back from 70 billion back in 2020 up to 82 million in the last report. Coming a bit down here to the net income, not growing as much, a bit stale, which could be a minor red flag to be honest. But if you scroll down a little bit more to the diluted EPS, you can see here they are indeed growing their EPS, so the management are doing some pretty good capital allocation, buying back stocks for example. Also jumping into the cash flow statement, you can see cash flow operations also quite stale, sits around 14, 15, 16, 17, 18 back in the different years. So not a lot of growth there, actually a bit up and down. But looking at the capital expenditures, they are pretty fixed. You can see 3.3 billion a couple of years ago, 5 years ago, and now 3 billion. So they are indeed not using a lot of money to actually earn money. Scrolling down here to see the free cash flow per share, we saw earlier that the dividend payout was actually just shy of $3.80 on a yearly basis. Jumping back here to see that the free cash flow per share is 5.8, so plenty of room to grow the dividend in the future as well. And if you take a look at how it compares to S&P 500, over the last 5 years, they have actually outperformed the S&P 500, a price return of 84 versus S&P 500 of around 52%. The last thing we want to take a look at before we jump into intrinsic value calculation is indeed the Wall Street rating. You can see here they have it as a buy, with a plenty of analysts having it actually as a strong buy. But if you come down here to the average price target, it's just 8% higher than the current levels. So indeed not that much of an upside from the current levels, I believe. But let's jump into a stock screen and take a look at some of the key metrics of PG and then also calculate the intrinsic value. As we saw here, we do have earnings per share growth over the last 5 years at 13%, looking extremely good, and I think they continue that into the future. You can see the PE ratio sits around 22. The 5-year average is around 33, so actually a bit low on the PE ratio. I do believe this could be a little bit mistaken. I think it's around equal to the 5-year average of the PE ratio right now, so I would need to double check that obviously. We are pretty close to the 52-week high. The revenue is indeed growing over the last years, as you can see here, roughly CAGR of 3% per year. They have a very low net debt to EBITDA ratio of 1.2%. As you know, if you've seen other videos, just below 3 is what I'm looking for here. Return on invested capital and return on equity also looking extremely good at 17% and 31% for those two. Analyst target price 166 as mentioned earlier, which could indicate the analyst target growth of 6% per year for the next 5 years. Margins are looking really good. PG has a lot of pricing power, so that obviously bodes well for the future as well. The 3-year dividend growth rate is 6%, the 5-year dividend growth rate is 5%, and the yield is, as mentioned earlier, just above 60%. But jumping into the dividend data tab here and zooming in a little bit more, what we want to see here is basically steady growth of the dividend. And as you can see here, it looks pretty steady around the 5 to 6% as mentioned just before. Coming down here to dividend yield theory graphs, you can see here that it looks to be actually fairly valued at the current time and has been for a little while now. But we do also have a lot of valuation models, so we want to jump into them. The first one is a discounted cash flow model. I don't want to break down everything here, so basically I just want to highlight that I'm using an applied growth rate of 4%. Also going into the dividend discount model, where I use an applied growth rate of 5% with the weighted average cost per capital being around 6.5. Multiples valuation, comparing it to other companies similar to PG, Graham's revised valuation model, PE model, and the free cash flow valuation, where we take some historical values and try to extrapolate a intrinsic value based on that. We also have the Peter Lynch model, where we do take the growth rate, the dividend yield, and the PE ratio, and then calculate intrinsic value based on that. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel and like the video. Let's jump into the summary, where we do have all our valuation methods here. So you can see here the average intrinsic value is $141. I do believe all of these are pretty valid, so I will not be excluding any of them. The current price is $153, so looks to be roughly equally valued or fairly valued at the current time. But obviously we also want to apply a margin of safety, and we do have our calculator over here on the right. So it takes a standard of 25, and then depending on some of the key metrics, either adds or subtracts a bit of margin of safety. I think for this one, even though it gives a margin of safety of 10, I think the payout ratio is pretty safe and it's just on the borderline. So I will be personally excluding that for this one. So I would be perfectly okay putting in 5 here instead of the 10. But let's see here if we start with 10. A taxable buy price of 127, and if we put in the 5%, the acceptable buy price becomes 134. So we are indeed pretty close to the fair value. I think a company as PG in these recent times trades at a bit of a premium. So if you are into PG, I think it's perfectly safe to actually buy into the company now. I think I would probably personally wait for a little bit of a pullback. I think it's slightly overvalued or at least fair valued. So personally, if I wanted to buy in, I would need a little bit of margin of safety just to be on the safe side. So I think it's a really defensive stock, and I think it's perfectly fine to own it. But I think if you were to buy into it right now, I think you were a little late to the party, basically. So I would personally wait for a little bit of a pullback before buying into PG. Thank you so much for watching, and I'll be seeing you in the next video.